Before a company spends even a single dollar on a new project, they ask themselves a simple question. How much does our money actually cost us? And the answer to this is called the WACC. Now, WACC stands for Weighted Average Cost of Capital. It is quite simply the average required return by the investors of the company. Basically, what is going to keep your investors happy? It is a weighted average of the requirements by the equity holders of a company, namely the dividends and the capital gain expectations, and the requirements by the debt holders of a company, namely interest payments and principal redemptions. Now, because your interest payments reduce your taxes, you will get a benefit called the tax benefit as well. So all in all, the formula looks like this. Now, let's understand the concept of WACC with the help of a company we all know and love, Apple Inc. Now, Apple finances itself roughly using 80% of equity and 20% of debt, right? That means the proportion of equity is 80%, the proportion of debt is 20%. Let's say their cost of equity, which is the requirements of the equity shareholders, is 10%, and the cost of debt, which is basically what they pay as interest on their borrowings, is 4%. And let's say that their taxes are 20%. They pay 20% of tax. Now, how would you calculate the WACC of Apple? You would take the cost of equity multiplied by the proportion of equity, and then you would add it with the cost of debt multiplied by the proportion of debt multiplied by your tax shield. Now, since your taxes are 20%, your tax shield is 80%. Now, this will give you 8.6%. Now, this means that Apple's projects and Apple's investments must earn a minimum of 8.6% in order to keep their investors happy. Who are the investors? They're both the equity holders and the debt holders of the company. If Apple happens to invest in a project that returns less than this 8.6% number, they are destroying value. And if they invest in a project that returns more than 8.6%, they are creating more value for their investors. Now let's look at WACC from our perspective, the investor perspective. The WACC is used to discount future cash flows of Apple in a DCF analysis in order to find the value of the stock. That means if you get the WACC incorrect, the entire valuation is incorrect. It is one of the most important numbers in finance, and now you know how to calculate it. For more videos like this, please follow.